Was it just carryover from the formatting on the police side?
Yes, yes, I guess it was carryover on the police side, fire
Okay.
down below,
Okay.
and you don't have anything.
It was just a budget item though.
That's,
Okay.
yeah, if you'll take notice on your budget expenses item,
Okay.
Michelle last time wanted something so she sees what the budget was originally and what the
Okay.
balance of the budget is, so I included balances on the
Understood.
other end.
Understood. It looks more concise this way. I can see everything at once. So I was just making sure.
Okay.
Okay. So do I have a motion to accept the expenses paid?
Motion to accept.
Motion by AJ,
Second.
second by Brian. All in favor?
Aye.
Aye. Motion passes.
All right. I think E is you, Mr. Latham.
Yes, Michelle last time wanted to do a study on the administrative fees. I emailed her to see if she had done anything. She said she had nothing for the board, so I just presented my letter back to you. Do you want to just go ahead with the increase of the $100? Make it.
Yeah. Did she have any? I guess was there any back and forth with her at all? Because I had no contact, obviously.
Yeah,
No
well,
meeting
I
time
asked
for
her
it.
if she had a study for the board, and she said she didn't have anything.
Okay. Okay.
Okay.
And that was the increase of $100. Okay. So, is there any discussion on the board members here? It was the $100 increase for Debbie for administrative fees, and obviously with inflation and things like that. So
good.
okay. Have a motion?
Motion to accept.
Motion to accept by AJ, seconded by myself. All in favor?
Aye.
Aye. Motion so passes.
Expense report, Deb?
Yep. Now, your expense report, basically, your all were under budgeted, so you had no problem. So what it is the expense report is required by the state as to what we expended during the year. And basically, your budget was for $87,700, and we spent on the police side $68,458. And on the fire side, your budget was the same thing, $87,700, and you spent $77,999.
Is that does that require an approval?
Yes, because we have to send it to the state.
Okay. Keep asking that today. Do I have a motion for approval of the expense report fiscal year 21-22? Motion to approve. Major Kewen whispered motion to approve. Do I have a second?
Second.
Tommy Blair is second. All in favor?
Aye.
Aye.
Were those numbers the same? Is that for both plans? Or is
Yes.
that okay? The 87.7 versus 77.99 coming in under budget.
And we're under budget, yes.
Okay. Yeah. Significantly under budget. Okay. Do I have a motion to accept the expense report?
Motion to accept.
Motion to accept by Brian, seconded by myself. All in favor?
Aye.
Aye.
Motion passes.
All right. G Golf, Debbie.
Pardon me?
Item G Golf renewal for fiduciary.
Yes, on the liability insurance, we have a new agent named Jake, and the premiums did not change. They were the same from last year to this year, and everything all nice and neat. I think the police was 38 something, and the fire was 37. You guys got copies of that? Oh, here we go. All right. On the police side, it's 3880, and on the fire side, it's 3362. That will be the premium for the liability insurance for 1 year.
You know why the fire is less than the police?
It has to do with, basis points, I think it is. There's something with the difference in, I think, monies or something. Yes.
Oh, by 500. Yeah. Yeah.
And what they did is they did a soft extension because both right now expired the first part of December, since we didn't have it till then. We have a soft extended expiration date, so I'll let If you approve it, then they're gonna send the invoice and go ahead and do the binding today.
So you need a motion from us, from the police side, on the renewal. Now, should we discuss cyber at the same time or do two separate motions?
The cyber, we can do cyber at the same time. Now, cyber, basically, they decided, when I got the email from Jake, is that they're gonna go ahead and allow us just on this little application, and we just choose the section we want. Last time we did the cyber insurance, it was $970 for the year, and, this year here, if we do the 250,000 liability, it's 800. It's less.
Somebody's got to explain to me how these two things are the only two things in the world that have not gone up.
Don't say it loudly.
Thank you, Carrie, yeah. Okay, can I get a motion to approve very quickly, the fiduciary liability coverage and the cyber insurance for police as stated by Debbie?
So moved.
Dan with the motion,
Second.
Major Kewen with the second, and all in favor on the police?
Aye.
Aye.
And for the fire side, renewal for fiduciary liability coverage, including the cyber insurance. I have a motion by Brian, and second by
Seconded.
AJ. All in favor?
Aye.
Motion passes.
Item H Hotel, Debbie, admin fee agreement with police pension.
Right, I've got the agreement here for you to sign today, and mine will start retroactive back to October 1st. Pedro will have to do one up for the fire, and he'll get it to me, and I'll have to get with Lason to sign
Okay.
it. So that's on those two.
I will sign that after the meeting.
What we did with the minutes and everything,
Okay.
and all that.
Okay. Item I, actuarial service agreement, police and fire.
Yeah, that was the one where we discussed last time with the, his fees went up on some certain things. So I have those agreements for police and fire through Foster and Foster to be signed at the end of the thing.
Did we leave that last meeting like with further discussion, or did we just say we table it and?
No, you
What-
guys approved it with the understanding that, it was only for a flat fee of 4%, and for 1 year, you relook at it.
I remember now, okay.
Mm-hmm.
Okay,
And that's here for you guys to sign. So
Okay.
Get them back their copy.
okay, thank you. Okay, Carrie.
All right, here we go.
You can, right,
Is that okay? I didn't want to throw the pager off, but I also don't want to knock anything over as I
He's just on the phone.
Okay, oh, good. Is it possible to put it down? I just don't want to break anything as I get in the midst of doing my thing, so. Good afternoon, everyone. Great to be with you and to see you. We will go through the books. This past quarter and fiscal year is gonna be a little bit painful, just full disclosure, but there's better news afterwards, so please kind of bear with me, through the discussion ended September 30th. And with that, we'll just flip open your respective performance books to page 3, which just show the market charts, as of the end of the quarter for a full year. So again, just looking at the top of page 3 there, we found ourselves in a quarter, again, where really public markets were negative across the board. And it's a lot of the same themes that we've talked about, for a few quarters now, probably since I've known you, and that is, obviously lots of concerns over inflation and kind of getting it under control, and seeing what the Federal Reserve was doing, aggressively hiking interest rates as they've continued to do, and we expect them to do again tomorrow. We're still in a situation where, geopolitically there's a land war going on in the Ukraine. And also, concerns over, are we headed for a recession, kind of what's in store. And you put all those things together, and again, pretty much across the board, public markets were negative. And so just looking at the top chart there on page 3, the S&P was down right about 5%. Mid and small caps were down as well, although not as much. Mid caps were down, call it 3.5-ish. Small caps down a little more than 2, and really that's a result of the stronger dollar. So most mid and small cap companies do their business here in the US. There's not as much international trade, so they held up a little bit better there for the quarter. But again, within equity markets, really nowhere to hide, domestically. And then you look at the international results as well. The MSCI All Country ex-US index was down about 10. The emerging markets index was down about 11.5. And again, some of that has to do with translating back to the dollar, but no doubt there were pretty much challenges all over the place for the quarter in equity markets. Within fixed income, that index for the quarter again was down just shy of 5%. We saw several hikes, significant hikes from the Fed through the quarter, and that just kind of comes through in the results there. There were, again, very few places to hide. You look at something like TIPS, which are inflation-adjusted securities that can be attractive in inflationary environments. Even they were down 5%. So really, public markets were just extremely challenged, for the period ended September 30th. Following on that theme, looking down just gives you an idea on the bottom chart of what that did to the one-year numbers. And again, S&P down, roughly 15.5% for the 1 year. Mid and small caps down, kind of high teens to early 20s. Overseas indices down in the mid 20s, with the exception of emerging markets, which was down more. And then the bond index, the aggregate index, down about 14.5%-ish, give or take. This has been the worst year on record for bonds. So when you think about our bonds, right, they're supposed to be our safe haven asset, the place that, that's supposed to be a relatively safe, stable place to put money, even if you're not getting much income from it, which we hadn't been historically. But again, that index had a historically bad year, the worst year in the index, and really for decades and really centuries, actually. But I think there is good news there, so I don't want to just, continue to be doom and gloom, and that is, with these hikes we've seen from the Federal Reserve, we're finally going to get some income on our fixed income securities. And so to give a little bit of color to that, even 4 to 6 quarters ago, the bond index that we talk about, the aggregate index, was yielding like 1. At the end of September, it was yielding like 4.7. And that was before the 75 basis point hike we got from the Fed in early October. And that's before whatever they do tomorrow, which is expected to be about 0.5%. So fixed income, that kind of risk-free asset class that we expect to be, a nice buffer and to be less volatile, is going to start to yield in the mid-5s for really taking very little risk. And so going forward, that's going to help us to get a lot closer to our return targets when fixed income is actually generating some meaningful return. And then I think in looking at equity markets, it's never fun to go through a 20-something% pullback. That's for sure. It can be very unsettling. But what it creates is opportunities for active managers. We've been in for many years, and I'm kind of roughly speaking, we had a few short-lived exceptions to the rule, but really since the end of the great financial crisis in 2009, pretty much an uphill trajectory, except for when we got into 2022. We call that kind of momentum, when everything goes up and certain stocks are very popular. Well, you're starting to see some of that shake out a little bit, and that should be very good for your active managers, not overpaying for names that they might want to hold, thinking valuations look a lot more fair. And so that's, this should be a better environment for our active managers going forward. A little bit of volatility, again, though uncomfortable, can create opportunity. So, again, very challenging quarter, though, in public markets, and led to some challenging one-year numbers. Real estate was positive again for the quarter, so that kind of real asset segment did hold up nicely. The index was positive about 1%. So we didn't get that 7%, 7%, 7%. We're not on track to do probably 25% a year ongoing like we did last year. But that real asset, and kind of that inflation protection that real estate can hold, did hold up again this quarter. I think the returns there will slow down, but it was a really nice buffer, I have to say, through a very challenging period in public markets. I'll just hit a couple of other charts within your book, and then we'll kind of move on. I'm just going to flip to 4 briefly and just talk, again, very high level about the style charts. So the top chart on page 4 shows you within the different market segments. So the top one is the 3,000, basically from mega cap on down to very small stocks. you can see growth actually did better than value, and that was really the theme for the quarter. Very unusual. We started the quarter with kind of energy holding up very well. It was one of the only positive sectors for the quarter. You know, defensive things, consumer staples, you know, toothpaste, the things we have to use in a recession. But then, you know, depending upon whether the market felt like the Fed was going to stay really aggressive or whether they would back off on their hikes, actually growth came into favor at the end of the quarter. And that just kind of goes to show how really volatile things have gotten here just in a couple of quarters. Because again, you can see the leadership of growth for the quarter, though pretty much everything was negative. And then you look down to the 1 year, and you see value strongly leads the way. Because again, those more defensive energy, consumer staples types of assets held up better kind of previous to this. But just kind of a very volatile type of environment, much more so than we'd seen over the last several years. And then I think I'll just kind of finish my comments flipping in your books to page 10, to the bottom right chart there, which is the yield curve chart. Just giving a visual to all this, you know, we can talk all day about interest rates rising, but I think a little bit of visual can be helpful. So looking at that bottom right chart on page 10, you know, the blue line is where we ended 2021, and the yellow line is where we were as of the end of September. So you can just see the absolute kind of blowout of rates. And I'll pick the 2-year for just kind of a point of discussion. The 2-year was at about 67 basis points at the end of 2021. It was over 4% at the end of September. So that just gives you, that's more than 3% increase over the period of a year. So it just gives you kind of a visual to the pain that we felt in the pricing of fixed income for the quarter. And I think one last thing I'll just say is the curve is also, you hear this term inverted yield curve, and that's really just a fancy way of saying interest rates are higher on the short end of the curve right now, which is much more influenced by what the Fed is doing, than they are on the long end, which is much more tied to, you know, very long-term GDP expectations, inflation expectations. And the last I looked just a couple of days ago, the 2-year was yielding around 4.30, the 10-year was yielding around 3.50. So that's 80 basis points difference between the two. That's a pretty inverted yield curve. What does that mean? Well, first of all, it's not a sustainable state, right? It's very backwards to earn more to invest short-term than long-term. Typically, what that inverted yield curve has meant in the past is that it is an indicator of recession. A lot of financial shops, I think, are projecting that we will probably officially be in a recession in 2023. They'll actually use the term, even though we saw 2 consecutive negative quarters of GDP in 2022. It wasn't officially called a recession. I think you'll actually see something officially called a recession in 2023. But because there's not a lot of excess in the system, so when we look back to past recessions, it was things like a glut in housing supply, some very irresponsible underwriting standards. Anybody could get a mortgage and lie about their income. Or inventory that was very oversupplied. So typically kind of excesses have caused recessions. It doesn't seem like there's a lot of excess in the system right now. And the labor market has remained incredibly healthy as well. So it's going to be interesting to see how all of that kind of shakes out. I think a lot of financial houses, JP Morgan and similar, think maybe it will be a mild recession. But strictly speaking, probably we're headed for some sort of, you know, recession on paper in 2023. So any questions on the economics piece before we get into your individual portfolios themselves?
Is that right? Do you guys got anything? Can I ask you something?
Yeah, please.
So just to kind of prepare everybody, is it realistic to say, because once we get over the inflation, right, then everybody has to come to the earnings, and the earnings have to get reset, correct? So should we as a board and as a body just kind of temper our expectations for the next 6 months? I don't know. Is that a stupid question, or?
Not at all. It's not a stupid question at all. I would say at a minimum I think the volatility will continue.
Because we're going to have another quarter, right? And then another quarter. So
yes. So you can also say, you know, the markets tend to be about 6 months forward looking. So projecting kind of ahead a couple of quarters. I would say 2023, will be kind of a bumpy ride. I'm not expecting big numbers out of equity markets, but any kind of small thing could make a huge difference. And what I mean by that is, a peace treaty in the Ukraine could make a huge difference. Sustainable lower energy prices, huge difference. Some of these things could make a very big difference. So Wes, great question. I would say I have somewhat tempered expectations for
Okay.
equity markets in 2023, but any little kind of change or tweak or unforeseen tweak, positive or negative, could totally change that.
Thank you.
I'm not necessarily concerned about the recessionary prospects over the long term. I think it may be a blip for a couple of quarters, just again because of some of the fundamental strength that we've talked about. But again, I'm not here saying I think we'll get 10 or 20% out of our equity portfolio in 2023. I say kind of buckle up, stay invested. But yeah, I mean, to use your term, tempered. Yeah, I don't know that we'll hit it out of the park in 2023, but anything could change.
Okay.
Hopefully that's an answer, but
That
my
is, thank
crystal
you.
ball is all kinds of cloudy. So
Right.
just flipping in your books to page 13, we'll get into the specifics of each of your plans. And I'll speak to fire first. So on page 13, that nice line graph of growth, and this goes back 10 years. So within this chart, we're looking at September of 2012 to September of 2022. So we started with a value 10 years ago of about 8.4 million. We are finishing the end of September 30th, 2022, just over 15.6 million. So for fire, specifically $15,639,190. And I just want to take a little look at the bottom there and give some long-term perspective, especially for a challenging quarter and fiscal year. Your 10-year annualized return fire plan is 7.44% over that 10 years. So we're about to absorb a very negative, high teens return for the 1 year, but your 10-year number is still at 7.44. I think that's pretty excellent. And then moving over for the police plan, you all were very similar in value, $15,666,991 with a very similar starting value 10 years ago of about 8.4 million. You all 753 on the 10-year, even with a very ugly fiscal year number. So I think, long-term perspective is obviously very important as we go through periods like this. And really sticking to your policy, sticking to your allocations, and just kind of weathering through and rebalancing has served you all very well. And then for each of the plans, we'll just advance to the next page, which shows kind of the overall snapshot of the asset allocations. So starting with fire, just over 45% of your assets at the end of the quarter were in domestic equity, so it's roughly 45.4% of the assets. Just over 13%, 13.1 was in international equity, 13.4% was in domestic fixed income, and certainly for both plans, you all taking that down was very opportune timing. That did protect you some in a very challenging environment, putting those funds in real estate. For global fixed, 4.8, real estate, 21.7, and we'll come back to that in just a minute. And then about 1.5% as well in cash for expenses, distributions, etc. And then moving over to the police side, within domestic equity, about 45.2% of your assets were there. About 12.8% of the assets were in international equity. About 13.5% was in domestic fixed income. Just over 5% was in global fixed. 21.6 in real estate, and then again, just shy of kind of 2% on hand in cash as well. And if we flip ahead just a few pages to 19 in both books. Just as a reminder for each of these plans, the gray section that you see shows you your range, which means kind of your allowable amounts for each asset class. The black line shows you your target, or where you kind of shoot to be over time. And then the green or red triangle shows you where you are within your band and how close or far you are from your target. So you'll notice you are, and I'm starting again with fire, you're kind of at the lower end of your domestic equity target there. You're closer in international equity, though a little bit underweight, similar for domestic fixed income. Global fixed is right on target. And real estate is a couple of % outside of your permitted policy targets. I would recommend taking a small draw out of that at this time. I would recommend, roughly 250,000, just to keep us kind of in line. It'll still keep you in very close to that outer bound, but it just keeps us within, closer to our policy targets and, those risk controls that kind of help us in a volatile time.
It would seem to me like since real estate's done better than anything we have, we'd be making a mistake to cut it back.
It's an excellent question. I think the steam is coming out of real estate a little bit. So we saw several quarters of 7%. This quarter, the index did 1%. And I think you're going to start to see a little bit of softening
Yeah,
there.
we're getting crushed everywhere else.
You are, but you could look at it as a good buying opportunity. You could look at it as cheaper domestic equity to be buying back into and rebalancing back into. That's why, honestly, Tommy, that's why I chose a small amount. That's going to be just a couple of percent. You're almost 7% overweight. I'm saying let's just take 2. Let's just get you back within a little bit, and it's still going to keep you overweight at that level. It would still keep you overweight, but within the parameters, not outside of that. And then moving over for police, you can imagine my recommendation is going to be very similar. You are also on the line for domestic equity, kind of the edge of the lower bound there. You're closer for international equity and domestic fixed income. You're right on target for global fixed. And again, you're close to, call it 21.5%, 22% in real estate. So again, just taking a small piece, a couple of percent, deploying it into equities, which arguably should be cheaper, we're buying lower, but keeping those important risk controls going in your plans.
Since this report is a month and a half old, I would have to think our percent of real estate is down from where this report shows.
Yeah,
Do you have
I
a
agree
current
with
number
you.
on
Yes,
that?
I agree with you. So equities have come back about 10%, but I still think things will be volatile, and that will just give you a little bit of room. If things do kind of pull back again, it just gives you a little bit of room.
So,
Well, I'm sorry, go ahead.
no, I interrupted you, Tommy, go ahead.
Well, I'm just kind of, we obviously are a little bit out of line there as of September the 30th, but the market has been up considerably since then, so that means that's come down. So how far out of line are we now?
Yeah, I don't have your current values. I just have been on the road all week, so I did not have the opportunity to pull them. I would
Are
say
these reports only done quarterly?
yes.
Okay, so it's a month and a half old report, so it's pretty much outdated with the way the markets are.
Yeah, I mean, I would agree. Yeah, you have rebounded some. I just, again, just anticipating probably some continued volatility. I would take a small amount personally, and I would put it back to work in other areas of your portfolio because I see the steam coming out of real estate. I think the managers are starting to tell you that too. Some of the appreciation in some of those areas is not sustainable. And I'm kind of looking forward. Obviously the 25% for the 1 year was awesome, but it's not sustainable. And so I'm kind of, pivoting for what's coming next.
And that reallocation would be dumped in somewhere, it wouldn't just sit.
What I would do is when we get it, I would pull your plan allocation and put it to work wherever you're most underweight. That's what I typically do because it's a nice natural rebalancing for your fund.
Because of interest rates are going up and the Fed is raising rates.
Yeah.
Should we maybe rebalance with more of an attitude toward more fixed income since we can grab some decent rates right now, which at some point, hopefully in the future, the Fed's going to swivel, pivot.
Yeah, yeah,
As they say, I don't know if there is.
yeah.
But hopefully if it is, we'd be in a much more profitable situation with our bond.
Yeah, I mean, you absolutely could do that. I think, again, really the most significant long-term driver of performance in your portfolio is equity. That's why I kind of lean that way, and it's the most underweight in the book. But I'm happy to, we can put it in domestic fixed income. There'd be nothing wrong with that because, again, it's yielding somewhere like 5% now. So, that's really the board's pleasure. I'm happy to put it there if you prefer. I always lean towards equities, again, just because that piece is really important.
Because the money's made when everything's down.
Right. Buying in and, yeah.
But we have never done well with bonds.
Well, I would say we're entering into a rate environment we haven't seen since 2005 or 6. I mean, we haven't seen interest rates at a decent level since way before the GFC. So,
But the more the rates go up, the more the bonds are gonna go down.
but I think most of the pain has been felt. It would be very hard for me to imagine the Fed going over kind of high 4s to 5% with Fed funds, especially with the 30-year anchored in the 3s. I think they're way closer to the end of their cycle than to the beginning. I think we'll get 50 tomorrow, and I think we may get 25 or 50 in January, depending upon kind of how things go and what, you know, what the Fed is seeing. But so there are indicators within inflation. So rent, for example, there's a 9-month lag. If you're seeing rents come down in CPI before it kind of filters its way, home prices, all that filters its way through CPI. And there's kind of a similar effect in some of the other components of CPI. So some of that may be down even more than what we've seen even as of the print today. But I do think most of the pain has been felt in fixed income. I really do.
So it seems to me like we're just talking timeframes, right?
Yeah.
So, you know, Tommy's talking real estate, that's one time frame.
Yep.
Dan's talking bonds, that's another longer term time frame. But equities, if we're gonna be in equities, we're in equities for significantly longer. Is that accurate?
I think over the very long term,
Right.
we're going to expect, you know, a
Sure.
superior return profile from equities. There's going to be much more volatility, but
Sure.
over the long term, 10 years, you know, beyond, you're looking at a superior performance from equities, I expect.
Yeah, I would support your recommendation, actually.
And just so you all know too, some real estate managers, because they've done very well and stocks and bonds and public markets have been down, they're getting a lot of rebalance requests. It may be a couple quarters before we even get it. And that's another reason why I say, let's get in line. It may be at the next meeting, if I come to you and real estate's down and we haven't been paid for it, we can rescind that. But I say now, because the Qs are backing up, it's just simple rebalancing because everybody's stocks and bonds are down as much as they are. A lot of folks are rebalancing real estate. It may be a few quarters before we even get it and we would have the right to rescind it. So that's an important point to make too.
That would be further down the line when the interest rates have played through and they've at least leveled off and maybe started to come down, which would be a pretty opportune to buy some equities at that point.
And I think, you know, just saying we can pull your asset allocation when and if we get those funds and put it to work at the time wherever they look the most attractive as well. We have the ability to do that rather than you all having to actually pick a bucket, you know, unless you feel very strongly you can always do that. But I can, the day I get the money, pull your allocation and put it to work wherever is the most underweight.
Are you guys not comfortable with that? Or are you guys comfortable with that, Tommy and Dan? Or?
I just think we've done extremely well with real estate, and I've been on this board 10 years, and we've never made money on bonds, and I just don't see that happening.
I think that we've made a lot of money in real estate, but I think that's probably time to get out a little bit too.
Well, they say you can't time the market, and that's what we're trying to do.
That's what I mean. I would, it would be my view that we pay you to make those decisions and you allocate it, but that's just my view.
And I would say just one more thing, if I may, too. Rising interest rates feeds through to real estate too. So if they want to send any if they want to sell any properties within that fund, and the manager that wants to buy from them wants to use any leverage, their leverage cost goes up. They're going to want to pay less for that property to make more money on it. So higher interest rates do filter through to real estate as well. You know, all else equal can make it tougher sledding for real estate managers too. When interest rates are high, their cost of borrowing goes up.
What's our target income return?
8%.
8%? So what our target is in our funds?
Meaning like your actuarial assumption?
Yeah.
Yeah,
Seven.
yeah. You guys are in the sevens. You're not. Yeah, it's not 8%. Probably historically you were.
We're
8%.
assuming 10%
And if
returns
bonds
every
are delivering
year.
5, 6%.
Ours is 10%. We want 10% returns.
We're pretty much
Yeah, I know.
close to that target return.
The problem with bonds is, it's not the interest they pay, they go down in value as interest rates go up.
That's true. If interest rates
So you
will
look,
continue going up, but if we're close to she thinks to the top of interest rates, and if we pick intermediate type terms, so we would be holding a bond for 5 years, and it has to pay full value when it's actually turned in, right? At the end of the term, to go down, they gotta pay the full amount at the end of the term. So if we were in a 5 or 10-year bond, would that be unreasonable to expect 5 or 6%?
No, over the long term, fixed income performance tends to trend towards the yield on the index, you know, over the longer term. And so if the index is yielding, I'm going to say in the 5s now, I'm sure that it is. You know, over the long term, you're going to expect the index performance to very closely approximate the income yield on it. What I think will happen though is I think, you know, I think we find ourselves in, again, Fed, stays kind of still maybe in 2023. I think they're gonna end up cutting at least a little bit after that. So I don't know that we stay stable at 5%. I think maybe 3% is a, over the very long term is probably closer to where we end up. But right now, I mean, the yields are very attractive.
I would be fine, I would submit that, just rebalance it as you see fit as it relates to the portfolio and its any deficiencies, but it's a board vote, so do we need to vote on that? Like,
Oh, absolutely, yeah, absolutely, because it's just my recommendation.
can't we just say we
that
trust
all-
you and just run with it? No.
We do offer that service, yes,
Yeah.
but right now, I'm not, we call that discretionary. I just make recommendations, you all kind of decide, so I don't have discretion over
Okay.
the portfolio, I just tell you what I think.
So if we take 250 out of real estate, you're suggesting we put it into
Domestic equities, yes.
That's my sense right now. What I would really do is when I get the cash, look at how your asset allocation looks and put it to the work wherever you're, kind of in need the most, wherever you're the most underweight.
If I understand, in real estate, we may not get that 250 out until 6
That's-
months, 8 months, a year.
Right, that's right. That's why I say, if we have another 10% run up in equity markets, the funds may go somewhere else. What I consider a best practice is the day the funds show up is actually to pull your asset allocation and see where you might be under the most and put it to work there.
So
That's
really, it doesn't matter what we
typically
decide,
what we
we gotta
do.
get the funds out.
Right.
And then we make a decision on what we're gonna do.
No, you can't tell when you're gonna get them out, so she has to be able, when they come out, to know what to do with them.
Same thing.
And that would be, you expect 6 to 8 months from now?
I think probably a couple of quarters, yeah. So if I had to say, I'd say probably earliest end of March-ish, realistically, possibly end of June-ish. Because there's, again, a lot of folks are trying to rebalance now because the only thing that's held up in the positive territory is the real estate. Stocks and bonds are pulled back and significantly so, especially as of the print of your book. We've gotten some back, but there's queues, what we call queues, folks that are waiting to get their money out because a lot of people need to rebalance.
So do we need a motion like now, or should we wait till the end of your presentation?
You gotta have them.
I mean, that is your choice. You could wait another quarter if you want to.
Well, no, I mean,
That's-
I would make it now, I just didn't want to get in the middle of your presentation and do it.
No, please do. I'm good to kind of put a bow on the discussion on rebalancing, whichever way you guys want to go.
So I would agree with what she says, and I would make a motion that we take 250,000 out of real estate and then at the appropriate time, we redecide where to reallocate it.
Or do we let her reallocate based on our benchmarks that we already currently have?
Do that too, yeah.
That's why we pay them to do that. I agree with Tommy that we've made a lot of money with real estate, but at the same time, we've made a lot of money with real estate and you gotta, okay.
And again, I'm very thoughtful. We're not taking all the underweight off. We're taking just a little bit of the underweight off.
Okay.
And if we meet again and the situation's totally reversed, I'm fairly confident we could probably rescind that, but you kind of want to get in line for the optionality, if that makes sense. To
So
be
they
in line.
They only liquidate so much real estate at a time, and so you gotta be in position, or it could be 30th, it may not happen.
That's right.
For
That's
9
exactly
months.
right. Exactly right. Yes.
So-
And again, you have the optionality. You could pull it back. People do that. I've seen it happen.
Things look different, we can take it out.
Yeah, if you get your December book and you're like, wow, things have totally turned around, the equity market rebound was sustained, we're way back into place, we can rescind it. I
So what do you think
guarantee you
about-
we're not getting it by the end, in the next 2 weeks. There's no way.
So what do you think about that, Tommy? If we make the motion now, when we get the book for next meeting, we're not gonna already have it pulled. If the real estate number shows bad, then we just rescind it.
Hold on. As I understand it, when you tell the real estate you want it out by X amount of money, that could be immediate, or it could be 3 months, or 6 months.
It's not immediate. The liquidity is quarterly, and that's kind of stated in
Would
normal
that be the end
markets
of
quarterly.
December, calendar
Yes.
quarter?
But typically with a certain number of days notice, so I guarantee you we will miss the December notice period. We're looking at March 31st at this period of time, because typically it's
And
quarter.
what would be the latest?
Hard to say. Depends on how long their queue
So it
is.
could be a year.
Yeah, it depends on how long their queue is. I'm not going to venture a guess. I think kind of mid next year is reasonable, but I'm not going to venture a guess. Just,
So we could always pull it.
I'm sorry?
we won't
could
make the
always pull
December
it.
31st redemption, quarterly redemption. You're looking at March 31st.
Yeah, if all of a sudden, interest rates start coming down, the equities look great, we may just, or real estate starts moving, we could pull it.
Yeah.
If they have
Yes,
to
you
take
could,
it
you
out.
can rescind it, yeah. And they like that as much as you do, believe me, they're like, okay.
So, Dan, do you want to restate that so we're all just clear? Dan, what you want your motion to be?
Me?
Yeah,
Oh.
you made it, right?
Yeah, I guess, I mean, that's what she said, and I kind of agree with it. I believe we should take $250,000. I make a motion to take $250,000 out of real estate as it becomes available, and at the discretion of the money manager, we redistribute it throughout the portfolio.
I would second that motion. Any discussion on that, Tommy or Ethan?
I think if we're gonna do it, we should put it in domestic equities, that's what she recommended,
That, okay.
rather than
That's my gut
redistribute.
feel right now. That just may change if we get the money 6 or 9 months from now, if that makes sense.
Okay.
That's my gut feel right now.
So if we were to say it's at your discretion and your gut feel when you get the money is domestic equities, that's what you would do with it?
Yes, and I'm gonna make sure, whatever I'm gonna do with it is gonna be in compliance with your investment policy, but that
Right.
said, assuming that it is, yes.
Right, all right, I would second that motion then. So any other discussion on that, Ethan or Tommy or Major?
No.
All right, all in favor of that motion, say aye.
Uh,
Aye. Opposed? Okay. Tommy, was that aye? Was that aye?
I didn't vote.
Okay, he abstained. So we got a, Ethan, did you vote?
Yes.
Okay, so we got a 4-1 on that. 4-0-1. 4-0-0.
So you technically can't abstain unless you have some sort of a conflict. So if you just don't feel comfortable, you should vote no, or you can vote yes, obviously. But the only way to abstain is if you have a conflict, and then I'm going to give you a conflict form that we have to file with the state.
Okay, just make it 5-0.
All right, he has, yes, he is, we're 5-0, Deb.
Oh, very good.
Okay.
The file with the state.
Or sometimes if there's a vote, sometimes people have to go to the restroom and they're not there for the vote. That's another.
We're just trying to keep you on your toes.
That's a permissible out, I guess.
You guys got anything? Or
You've
you
earned
good
your
to get
money
started?
today, Pedro.
Thank you.
I think we're done with
My
that.
wife will be happy.
We're done with that, right, guys? That topic?
Yes.
The police side? Okay.
And then fire, I obviously would make a very similar recommendation to you.
Yes, of course. So for Fireside, I have a motion to take the $250,000 as directed by our fiduciary manager, and when it appears and materializes, whatever the market does, she'll see fit to make it work,
Yes.
is what
yes.
she paid for. So that's the motion. Is there any discussion? Did you have a question?
I had questions, but they've all been answered.
Okay.
So I make a motion to accept your
Okay, so
recommendation.
a second? Okay, so motion by myself,
Okay, you made the motion.
yes. Second by AJ.
Okay.
Okay, all in favor, say aye.
Aye.
Motion passes. Thank you.
Thank you very much. I think that's very good.
We don't need you to do anything. You're
I
gonna
will
do it.
get forms for you. I actually teed up, ASB, I have another manager that's ABS, I always get them confused. I
How much
teed
money
them up.
did we move to real estate a few months ago?
I wanna say it was 1.4 million. I'd have to double check my numbers. Let me look
Okay.
in your book.
That's close enough, thank you.
We've got let's see, on your. I wanna say it was 1.41 million, Tommy, but it was over $1 million comfortably. So, and I can get you the exact amount too if you'd like to see that. From there, I will just flip in your books to page 22 and we'll get into the performance for each of your funds. So starting with fire, for the quarter, the fire plan was down just about 3.7%. The index overall was down about 4.5%. Again, coming off of a very challenging period, and this is net as well, that puts you down just about 18% on the fiscal year. But again, looking out to the longer term, you are still positive about, 3.6% on the 3-year, about 5.4% on the 5-year, and then over 7%, about a 7.2% on the 7-year. And I think, challenging quarters, fiscal year is always tough to stomach, but I think a little bit of perspective and considering the fact that we've had decades high inflation, we have a land war going on overseas, and we've been through a pandemic in the last 3 years. I think it's actually pretty impressive that you're, even positive on the 3-year number. So And again, that, 10-year number in kind of the mid-sevens, so your very long-term numbers, still strong for the fire plan. And then just kind of top-line review for police as well. For the quarter, net of fees down about 3.5. Again, the index down about 4.5. You all down about 1770 on the fiscal. And then looking out again for some longer-term perspective, about a 3.9 on the 3-year, about a 5.5 on the 5-year, and about a 7.3 on the 7-year. So thank goodness for those really good years that we had post GFC. Still again keeping those numbers reasonably high over the longer term. Within the individual segments for the quarters, we'll just kind of look at equity overall. So with domestic and international equity, for the fire plan, you all were down about 5.6. The index was down about 5.8. Both police and fire down pretty much on top of each other again, down about 5.6. Across the plans, both of you were down about 4.5% within domestic equity, which was right on top of your index. So all spring growth down about 5. The index was down about 360. And we saw this theme that actually impacted both Allspring and Touchstone, and that's some of these software providers were under pressure. Some of the valuations, any sorts of concerns about short-term demand impairment, any sort of lingering supply chain issues kind of pulled down some of these software-related names, even if the managers still really like them. So again, you see Allspring down a little bit more than the index. And that impacted Touchstone as well. Touchstone in the mid-cap side down about 3, but the growth index was only down about 60 basis points. Within extended markets, again, that's everything after the S&P 500, down about 2.7, and that's an index, so you just get the market return there. Legg Mason Brandywine down 4.5. The value index was down 5.5. So you did get a bit of protection from their kind of quality focus, and those more reasonable PE price stocks did help them. And then finally, Vanguard Equity Income down 5.3. Again, the index was down 5.6, so they did give you a little bit of protection as well. Some of their defense names, kind of the Lockheed Martin kind of types doing very well, as well as a couple of pharmaceutical names did help lift them in a negative environment a little bit over the index there. For both plans, down about 9.3 in the international equity segment. Overall, the index was down about 9.8. So that growth style actually did help them a little bit, as well as some of their Japanese bank holdings that did well, and a name called Mercado Libre that's like the Amazon of South America, which did well for the quarter too. Within fixed income across, both plans, both were down right in the neighborhood of about 3.5. When the index overall was down a little over 5, about 5.3. So your domestic manager, Dodge & Cox, down just about 4%, but significantly less than the aggregate, which was down 4.8. They are taking less interest rate risk than the index. They've kind of continued to do that, so they did protect you a little bit there for the quarter. Similarly, PIMCO Global Bond in the global space, for both of you, down just over 2%. The government bond index was down about 7.6, and the global ag down a little over 3. So kind of high cash positions and short duration helping you there. And then ASB, again, our kind of bright spot, our positive performer for the quarter up 224, with the real estate index up about 96. And they did say, they're seeing the kind of the leadership change. For a long time, industrial really led the way, and that was kind of in third place for the quarter. But some of the retail, the single family and multifamily types of properties, still holding up pretty well, and a little bit of a push from self-storage as well. So again, these are very challenging times in the market, but I think the silver lining is it should be a better environment for managers that are actually picking stocks. And I think historically sticking to your allocation and rebalancing has helped you quite a bit. So I definitely recommend that we continue that course through what I expect will be a volatile few quarters to follow.
Any concerns about internationals? Last year, we're kind of 99. I see that over 7 years or 3 years we're okay, but any concerns with us being like almost the last year?
Yeah, it's a great question, Wes, and I'll say a lot of that has to do with style. Is just kind of the more growth bias over value that was it was a huge headwind there for the fiscal. So I don't have long-term concerns. I actually consider Euro Pacific to be one of the best in class managers.
Okay.
But the, managers that don't hold a lot of energy or a lot of, again, kind of really defensive utilities, consumer staples on a 1 year basis, it was a huge drag.
Yeah.
So definitely, definitely a challenging fiscal year, no getting around that. But I think, even just looking at their ranks over time, they're 9th in the universe for the 5 year, 7th in the 7th year, 8th in the 10 year, 5th since inception going back to 2006. Really good manager. It's just a great illustration of how wide the disparity of market performance has been.
Thank you.
It's incredible. Yeah, no, it's a great question.
Do you have a current, figure on the value of our fund now, since this is a month and a half old?
I don't, Tommy, but I would be happy to send one to Debbie and have her send it out.
It's gotta be significantly more than this.
Yeah, I would say you're probably positive to the tune of 5 to 6% if I had to pull a number out of the air, just based on where equity markets have come back pretty significantly, and actually rates have backed off a little bit. So both fixed income and equities are positive as of the end of last week. And I think because the inflation number was good today, I expect that markets are positive today still. They were when I left the Tampa area, so I'm expecting that hopefully they're still positive. So I'd be happy to do that, to show you where you are, and I'll get it to Debbie and she can send it out. And I will do that for both plans, to be very clear, fire and police.
Thank you.
Absolutely. Hearing none, I'm gonna go sit back down unless anybody thinks of anything.
The only thing on the agenda there was rate of return for next fiscal. I think we kind of touched on it, but.
So Debbie and I were talking before the meeting, typically we pair that with your actuarial valuation, because it's this whole exercise where whatever your assumption is in that, the state wants to see you declare the same in your letter. So we will move that to February. We'll pair that up with when Doug is here, and we'll do that at that
Okay.
time.
Thank you.
Absolutely.
Thank you for your time.
Yeah, absolutely. It's a pleasure to work with you. Thank you for your time.
You guys got anything else? Okay, moving on to item K.
These are the dates that was presented. The times don't have to be at 1:30. We can do the 3 o'clock. She said anything from 1:30 on. So I didn't know if you guys wanted to do something different, or if you want to stay with 3 o'clock.
Was the 1:30 you guys?
No, we were gonna do the mornings, but it was,
Okay.
through everything off.
I'll leave it up to you guys. We're here.
What is the date?
I got February 7th, May 2nd,
August 1st.
August 1st.
And then November, I have to get with Doug or get with Jessica to find out maybe later in November, because Doug just can't get the report out in the beginning of November.
But the times are 1:30, Dan. Is that an issue?
Those are all Tuesdays, right?
Yes.
Yeah, that's fine.
Ethan?
I would like for us to consider having our meetings closer to the end of the quarter, so these reports would be more current rather than a month and a half old.
I have to get with, so let's see, because December, she won't get this December one till February.
Right.
Yeah. So we'd have to switch,
Well, I'm not
we have
talking
to
about
somehow-
changing them these days necessarily, but in the future,
In the month, you want the,
if
basically
we
the
could,
months
if we could meet
change.
roughly the middle of the month following the next quarter,
Right,
we'd have up-to-date information.
all right, let me get with Jessica and find out what is,
May I, do you mind if I
Yes.
speak? It's tough with my schedule and Pedro's, but what I can do is, I can bring an interim update from now on if you'd like. Candidly, that would be easier, I think, than rescheduling, cause I know Pedro's real busy and Debbie, I don't know what.
Well, that's why I'm talking about it, in the future, not necessarily these dates we're talking about now. But it's the same amount of time for you and Pedro, it just would occur at a different time.
He's saying,
To be honest with you, there's a lag in statement receipt at the end of the month too, so if I see you guys February 7th, we probably won't have the Salem statements even for January by that point in time.
Yeah. Okay.
website.
Okay.
And I'd be happy to, I can make that a regular practice, and that way you can keep your schedule, but at least you have an indication that's more up to date of where you are. I'd be happy to do that.
Okay.
And that way you can kind of keep it the way it is today.
Are you guys good with those dates?
Yeah, and 3 o'clock, I mean, this has always been 3 o'clock, it's been
Yeah,
fine,
it's
just
always
pushes
been
it toward the end of the
stick with
afternoon.
3.
I mean, it's been like that forever. But the push that was, this may have some questions that we were gonna move it to the mornings, and it just, every other entity that deals with our plan, it was just lopsided everything, so we kept it in the afternoon. And one thing to say, like, closer to the end of the quarter as well, we're not the only retirement plan that they administer as well, every entity, so I think we've asked that before. Now, may have been a while ago.
But we are the most important.
Yes, we are the most important according to me.
Right
So,
now.
Yeah.
That probably also worked out.
In an hour.
But that is
Something different.
Yeah, but we do understand that.
Right.
We understand that fact.
Yeah.
So are we staying at 1:30 or?
And this,
I say just keep it at 3, because I think it's,
you know,
that's,
Yeah, so I'm cool either way. Yeah. I'm
Pedro?
cool either way.
Yes.
Are you good with, keeping it at 3, or do you wanna roll 1:30?
I don't know. Deb, did you talk to Jessica?
Yep, she said anything from 1:30 on.
Okay, so then it's up to you guys. If you guys want to keep it at 3, it's fine. Or if you want to leave it at 1:30, I'm happy to do either.
Whatever. Okay, so you wanna roll to 3?
yeah, it's fine. It's been a way forever.
Okay.
3? Okay, we'll change it to 3.
Okay, for all.
Yep.
The on date would change is
Deliver
on
4 days
November,
a year, I can
because,
manage.
we'll have to get with, Jessica, find out where it's a good date, in the middle of November. So working at work, yeah, Doug can get the,
Okay,
his report available.
okay. If there's nothing else, I'm gonna move to item L. You guys have anything else on that? Okay. Item L, Pedro.
Okay. So and just to confirm, it's the same dates, but we're keeping it at 3 p.m.
Yes, sir.
Okay. All right. Okay. So I think Deb and you got to help me out here, but I believe I know the SPD, we're working on updating that. We're going to get Doug to get us the actuarial fact sheet. So I guess we could have that for the February meeting, I'm sure, for the board.
Right.
What was it on the rules and regulations? I apologize.
The rules, regulations, we tabled to now because all the updates that you had made changes to, they haven't been approved yet.
Were they formatting changes or was it new language? 'Cause I see it in red and underscored.
Yeah.
Which one is-
Basically, they've added stuff in here on the rules and regulations.
It was mostly the drop plan.
Yeah, there was, let's see,
Back to table
like on
contents.
the fire side, there was like on police also, independent contractors were added.
Yeah, the definitions for the,
Definitions for the deferred, drop, missing benefit recipients. Something about rollovers, they added something like 5.5 for rollovers. They added, actual studies for individual plan members. And they added an annual actuarial statements, conflicts of interest, contracts. And that was it. And, all of you, I had to go and print these out and send.
Is this what we had at the last meeting, Deb?
This is, we were gonna discuss it last meeting, but we ran late, so we tabled it again until today.
I got you. I'm sorry. Yep. Now I remember. Sorry about that. So I think you guys went over it just now, but you do see the changes. We left them in red line, so you would see what was the language that was being added, or if it's stricken, that means it's being deleted, obviously. But it's really just to kind of memorialize what we've done and what we changed.
Yes. Okay.
So if you're comfortable with it, a motion would be in order to approve and adopt the new rules as presented, or obviously we can discuss or have any questions or comments or anything on anything you guys see.
Is there anything you would deem significant other than, just anything that kind of sticks out?
No, I mean, I think a lot of it is, this is a kind of a big housekeeping exercise, really. It's just bringing us up to date with, the rules. They were a little bit old at this point, so I think a lot of it is just updating and kind of as the plan has changed, we've just added, some of the board's actions, going forward, but nothing, nothing, significant or earth-shattering by any stretch.
Okay, so we need a motion? So,
Correct. Yeah, motion to adopt the rules and regulations as presented or as revised.
do I have a motion?
Motion.
Major Keelan, second. Tommy Blair, all in favor, say aye.
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 And for Fireside, I have a question. It was on the drop language that was added. I'm assuming it's added or it's a change, but it's for the annual statements. I'm just wanted to make sure that we are still getting, like, when you're in drop, you get like quarterly statement. Is that?
Yes, they get quarterly statements. I basically went to, like, today, at the end of the quarter, I'll get with, Carrie and tell her, okay, send that information to Foster and Foster so they get to the drop participants so they get it in a timely manner.
Okay, because it was wondering here was the annual report for those that had elected the drop member. So it highlights them as a specific thing. So they're getting it quarterly. This says annual.
Right, we're getting quarterly, we're not getting annual.
We can make that change. I thought maybe I just didn't know. So I just put annually, but we can certainly make it quarterly.
Yeah, change that to quarterly instead of annually.
Okay.
Are you gonna do that for both plans?
Yeah,
Okay.
I'll make it for
Okay.
both.
Okay, thank you.
Because the other one was basically like almost like a hold harmless kind of a contact for somebody going into drop that they're aware they can seek their own independent legal advice. That was that item A thing, which it seems like it's just bringing it, modernizing the drop agreement
Okay.
because it wasn't there before.
Now, on the drop agreements, Pedro, do we need a new form for that, or would the old forms still suffice?
No, I think the old form still suffice. I think we didn't change the terms really.
Okay.
Okay.
Cool. So you changed
Do you
item B.
want me to look at? Do you want me to? I don't know if I looked at the form, Deb. Do you want me to look at it? If I want to update it, I can send it to you, and we can look at it at the next meeting.
Yeah, that'd be fine, yeah, just to make sure it's got the right stuff in it then.
Okay, sure, I'll do that. That's no problem.
Yeah, it's just the big one is that item B was the quarterly versus the annual, which
Right.
when you're in drop, you want to make sure you know when to pull the eject button if you're a drop. So you can save the quarter by going out in that quarter rather than waiting. So on a down market, it's a huge benefit. So that's where your reports come in very handy for those guys. Okay, that's all I have to say about that one. So those changes will be reflected, and then you can move forward. So are we able to vote on this to make sure that? Okay. So I have a motion for the update for the rules and regulations. Specifically, the item B will be changed from annual to quarterly, as it is now. So I have a motion to accept those changes with that adjustment.
Seconded.
And second by Brian.
Who did it first?
Motion for me.
Okay.
Second by Brian. All in favor?
Aye.
Aye. Motion passes.
So now we just got the summary plan?
Now, the summary plan has already been approved,
Okay.
and we're just now waiting for Foster to do up.
You guys, right? You guys had looked at it at the last meeting, I believe it
Yeah,
was.
okay.
I mean,
Yeah,
it was
there's no
the meeting
changes.
before that, but
Okay.
you approved it. But part of it is that there's an Exhibit A that's essentially an actuarial fact sheet, and it's kind of just a summary of the actuary will put it together from the most recent valuation report and include it as part of the SPD.
Okay.
Cool.
Okay. You got anything else, Pedro?
Yes, just a couple of housekeeping items, and I'll let you guys go. So first, I usually use this opportunity, since it's the beginning of the gift giving season, to just refresh your memory with respect to state ethics laws and your obligations thereunder. So obviously, as you guys are aware, by virtue of your service on the board, you are technically considered a public official, which is another reason why you complete that financial disclosure form 1 that we all love so much each year. And so if you're given something of value, regardless of the value, that you believe is being given to you to influence your decisions on the board, you should obviously reject that. If you're given something that's valued at $25 or less, you can accept it, and there's no reporting requirements. If you're given something that's valued between $25 and $100, you can similarly accept it. However, there is a reporting requirement triggered on behalf of the gift giver, right? So the person or company, entity that gives you the gift needs to file a form with the state advising that they gave you the gift and what it cost. And then lastly, if you're given something that's valued at $100 or more, you should not accept it. And we recommend filing something with the state, just advising that you received the gift, who gave it to you, the value of the gift, and ultimately the disposition of the gift, right? What you did with it. You donated it, you returned it to sender, whatever the case may be. Does that make sense? I know I went that through that really quickly, but you guys are all varsity at this point, so.
Makes sense. You guys got anything?
Okay. And then just kind of, oh, I'm sorry. Was there a question?
Tommy just said no one has given him anything. He sounded a bit disappointed.
I keep hoping somebody.
So, and you know, historically we have given holiday gifts, but when COVID hit, we kind of stopped the practice. And instead we started making charitable donations in each of our clients' names on their behalf. And so this year we'd like to continue that, and we selected the American Red Cross Hurricane Ian Relief Fund. So if that's acceptable, you know, that's what we'll do again this year in each of the board's names. However, obviously, you know, just as in the past, this is your gift, this is your donation. So if there's another organization or another charity that you would prefer, you know, we're happy to do it. Just let me know.
One question I have, on the cyber liability insurance, I'll be filling that out, and then as the administrator, can I go ahead and sign that?
Yes, you can sign it on behalf of the board. Yep.
Okay, and also the limit amount. Did you guys decide to go with the $250,000? Which one you guys chose?
Yeah, it was the 250,000 for the 800
Yeah, well, I was
something
at
dollars.
800.
Yeah.
Is that what we decided last meeting?
That was for this meeting. The last time was.
Oh, okay. I see what you're saying.
For 250.
That's what we had last time. Is what I'm.
Yeah,
I think, Deb, are those the ones you sent me?
Yeah.
Yes. Yeah, I think those are fine. Those are good. Those are acceptable.
All right. Okay, I'll take care of that too.
Okay. And then really lastly, just educational opportunities. The state actually has a conference. It began today and it goes through Thursday. I'm actually going to be, I'll be flying up there tomorrow morning and attending some meetings and speaking there. But the FPPTA is having a conference as well at the end of January 29th through February 1st. Also in Orlando at the Rosen Center. So if anybody's interested and the dates work out, you know, that might be a good one to get to. And other than that, that's really all I had. Happy holidays, Merry Christmas, Happy New Year.
Merry Christmas.
Pedro, before you go, what is that
Yes.
conference, that January 29th conference? What's the name of that?
Oh, it's the Florida Public Pension Trustees Association, FPPTA.
I'll send it to you. Is that the one that was canceled due to the hurricane?
Yes, well, they were actually both canceled because of different hurricanes, I guess. One was well, no, it was the same one. It was Ian. I thought maybe the other one was Nicole, but it was they were both canceled. Yes.
Okay.
Okay. Anything? Does anybody have anything else?
Move to adjourn.
Motion to adjourn on the police side by Tommy. Ethan has enthusiastically gave us a second. So all in favor? Aye. Okay.
All right. Just want to say Merry Christmas and Happy New Year to you guys, Debbie, Gary, and Pedro on the fire side, and to all of our brothers on the police side. But a motion to adjourn. I'll put that motion up. Second by Brian. All in favor?